In his book, The Changing World Order, the billionaire investor and hedge fund manager Ray Dalio describes where approximately every 100 years the world reserve currency exchanges hands as a new empire begins its rise. In this video, we're going to explore what a world reserve currency is, how it affects you, and look at some practical investment strategies to protect you if the dollar's time does indeed come to an end. For the past 100 years, the US dollar has served as the world's reserve currency. But before the dollar, the British pound had its moment in the sun. And even prior to that, the French franc held reserve status. As of yet, the US dollar is still the world reserve currency. But what even is a reserve currency? And why is this important to you and your investments? Well, when countries want to trade with each other, they take a risk in purchasing their competitor's currency. A currency can't guarantee another's fiscal policy, so an intermediary currency is needed to help make international trade a smoother process. This is where the world reserve currency comes in. It's characterized by stability, and as a result, different countries trust that they can make transactions using it. The US dollar has been characterized by this stability over its past 100-year reign. But that's not the only effect that being the world reserve currency has. As all countries need to be ready to trade, they hold something called foreign exchange reserves, which basically means a wallet of foreign currencies, including dollars, always ready and on hand to be used for trade. Rather than just sitting on their excess in this wallet, countries will invest their extra dollars in US securities and treasury bonds, which equates to a lot of foreign investment flooding into the United States over the past century. Currently, China, Japan, and the United Kingdom are the three largest holders of US assets through their foreign exchange reserves. Their combined investment adds up to almost $2 trillion. So that gives you an idea of how advantageous being the country with a world reserve currency can be. As well as the two factors I've just mentioned, the United States dollar reign has been characterized by another interesting and unique factor, the petrodollar. In 1973, the US government signed a deal with Saudi Arabia, whereby anybody trying to buy oil from the Saudis would have to use, you guessed it, the good old US dollar. And at the time, both countries were happy. The petrodollar agreement further bolstered the US currency, as any country in need of Saudi Arabian oil, which is basically all of them, would have to use dollars in order to get their hands on it. Now, that's what's been happening for the past 100 years, and the United States, like all empires, has benefited tremendously from the world reserve currency status. However, as Ray Dalio discusses in his book, all good things must come to an end. And in recent years, due to mounting tensions and the weaponizing of the currency, various foreign powers have been forming alliances which allow them to avoid the United States and its dollar. For example, in 2014, China and Russia signed a 3-year currency swap deal, cutting out the dollar. And in recent years, the BRICS nations have been exploring plans for a common currency, allowing them to bypass the United States completely. While it appears that the actual price of the dollar is going up, the amount of currency held around the world is going down. This, combined with the mounting foreign alliances to challenge it, is what's driving the idea that perhaps the current world reserve currency is experiencing its final days. Now, all the videos that you'll see about the end of the US dollar might be good for getting clicks, but in actuality, it's not likely that the dollar will collapse anytime soon. And most economists would say it's probably impossible. On the other hand, just as every world reserve currency in history has reached its end, it is entirely possible that the US dollar may slowly fade from its status over the coming decades as the geopolitical landscape changes. So all these recent hikes in inflation, along with the risk of de-dollarization of the US dollar, might be giving you cause for concern. And you might be wondering, so what does this all mean for me? And how can I protect my savings and assets in the face of a declining currency? Well, fortunately, there are options for those who want to protect their savings and wealth from a potential US dollar collapse, or at least protect it from inflation and de-dollarization. And it's also an added bonus that most of these practices are also just pretty smart investment strategies in general. So if you break each one of these strategies down to its core, it really all boils down to diversification. And in this video, let's explore some of these options. And please remember that this video is definitely not financial advice and it's for entertainment purposes only. So the first way that you might protect your wealth is to invest in gold and precious metals. For centuries, gold and precious metals have been used as a form of money and a store of value. In times of political disaster or economic downturn, precious metals can be considered a safe haven asset for multiple reasons. First, they can't be printed like paper money. so their limited quantity allows them to better hold their value over time. On the other hand, gold and precious metals don't yield any income, so in times of high interest rates, they might underperform compared to other financial assets. You can invest in gold in two ways. One, by physically owning it, which can be impractical and a bit of a security risk, or you can also invest in gold IRAs. A gold IRA is a specialized individual retirement account which can allow you to hold physical gold assets or precious metal related securities. Most investors tend to go with non-physical gold IRAs, but you can also invest in other precious metals such as platinum, rhodium, and palladium. However, keep in mind that these other metals tend to be more volatile than gold. The second way you can diversify your portfolio is by investing in Bitcoin and other cryptocurrencies. Cryptocurrencies aren't controlled by banks or other financial institutions, and if you take some investors' word for it, crypto is the way of the future. Now, I'm not saying all that, but Bitcoin and other cryptocurrencies are alternative financial assets, which may hold their value even if the dollar doesn't. There's opposing evidence, some showing that a decline in the dollar will positively affect Bitcoin prices and other evidence indicating the opposite. For most reserved investors, the volatility of cryptocurrency might prove a little too stressful, but if you have some savings to spare, diversifying your portfolio with crypto means that you at least have a finger on what could prove to be a very lucrative pie. The third way to hedge your bets against the dollar is pretty obvious, and that is simply to hold foreign currencies. Many banks now offer multiple currency accounts, which allows the account holder to receive and hold foreign currencies without the hassle of opening international bank accounts or converting them into US dollars first. An investor who understands the long-term economic trends in one country versus another might choose to buy and hold foreign currencies for months or years to achieve a profit. And as a long-term investor concerned with the dollar's value, it's not a bad idea to diversify and hold another country's currency. Leading on from foreign currencies, the fourth asset to diversify your portfolio with is foreign stocks and mutual funds. In addition to earning appreciation, investing in foreign stocks allows you to make money if the value of their currency goes up. There's a few ways for investors to get a piece of foreign business. The first is by purchasing shares of large American corporations with majority international sales, which means that your investment is less reliant on the United States economy and currency. Another way, and arguably the simplest, is to invest in funds which purchase foreign stocks directly. If you want to invest in foreign stocks directly yourself, you can either buy the company's real shares or their American depository receipts, otherwise known as ADRs. Some large overseas companies offer ADRs which trade on the US stock market and make it easy for American investors to buy foreign stocks without having to do business across borders. ADRs trade in US dollars, but their value fluctuates depending on how much the dollar is worth relative to the stock's native currency. In simple terms, this means that the price of your ADR shares will increase as the dollar falls. Now, the following option may not be available to everyone, but most investors agree that real estate is one of the best assets that a person can hold. Real estate tends to maintain, if not grow in value, and even in times of economic downturn, properties tend to bounce back reasonably well. If nothing else, property owners are at least left with the physical property should their other assets fail. However, it is worth noting that real estate investment can be tedious and time-consuming, and if you don't want to pursue investment as a career, owning too many properties could become overwhelming. Home ownership is a good ideal to achieve and will insulate investors from the worst if the dollar continues to devalue. At the end of the day, focusing on what you can and diversifying your assets is the key to withstanding the further devaluation of the dollar. And if you'd like to see more investment tips, be sure to watch this video right here on the best dividend stocks to buy if you're looking for monthly passive income. So that's it for this video, and I'll see you on the other side.